Hello everyone. Welcome to series of sessions on professional marks introduced in advanced audit and assurance exam. I'm your tutor Owais Mirchawala, and as you all know, we have already conducted first session on professional marks. In that first session, we had a discussion that what the professional marks are and what is the expectation of the examiner. Today, we will be moving towards the first specimen exam given by ACCA in this regard. So let's look at how you can find the specimen exam, and then we'll solve the first question of the first specimen exam. First, you have to go to accglobal.com. I hope you all know. Then you will go to the Students tab, and then you will go towards Study Support Resources. Okay. First, you go to ACCA Global, then Students, and then Study Support Resources. Then you will click on your qualification ACCA, and then you will click on your exam, Advanced Audit and Assurance. Now you will drag it down, and you will move towards CBE Practice Question ACCA platform. Okay, now you will click on this and it will read out you to the ACCA practice platform, and you will click here to log into the practice platform. Once you go to this screen, you will use your user ID and password to log in. Okay, now you will reach this screen, which is of test reach. Once you will enter your user ID and password, you will enter to this screen. You will click to the login, and your software will get logged in. In your case, it will be just a candidate account. Okay. Now, on this screen, on the right side, there is a catalog. You will click on Advanced Audit and Assurance. Then you will click on International. Then you will click on ACCA Official Resources. And see, here it is, practice exams valid from September 2022 session onward. This will include the latest specimen exams. You will click here, and here are the specimen exams. Practice exam 1, practice exam 2, practice exam 3, okay, and the specimen paper and the mock paper. So here is the list of papers which is given by the ACCA. You will click on assign, okay, and then this paper will appear here. Okay, so now I've already opened the screen, so in my case it's resume, but in your case it will be just a start, and here will be your screen of the examination. You will click next, and here your first question will appear. There will be multiple screens. You will click next, and the first question will get over. Okay, so this was the journey that how you have to access the screen, how you have to access the first specimen paper. Now we'll start discussion on the first question of the practice exam 1. I want you all to concentrate on. Okay, AAA International Practice Exam 1, valid from September 2022. Basically, the difference is that now you get 10 professional marks in the question number 1, 5 professional marks in question 2, and 5 professional marks in question 3. The structure of the exam is same. There are 3 questions. Question 1, 2, 3. Question 1 is of 50 marks. Question 2 is of 25 marks. And question 3 is of 25 marks. But the only difference is that earlier there used to be 4 professional marks in the entire paper. But now there are 20 professional marks. Now these professional marks are divided in such a way that question 1 will have 10 professional marks, question 2 will have 5 professional marks, and question 3 will have 5 professional marks. In the today's class, we will discuss the first question, which is question number 1. Many students ask me this question that, sir, whether these professional marks have made our exam easy or it has made it difficult. So I would say that if you follow the proper communication approach, if you follow the proper evaluation approach, then it has made it easy. But if you don't use proper communication, if you don't use proper evaluation and analysis, then you will be losing marks in these professional areas. Now, what my approach is, that today we'll discuss question 1, then we'll discuss question 2, then we'll discuss question 3. That will complete our first paper. Then I'll discuss one more paper with my students. And then I will ask my students to do the other papers like specimen paper 3, do the mock paper, and then send me for the marking. Because when you will take feedback from me, then only you will be able to identify that what are your errors, how you have to improve. Okay, so the key to improve in these professional marks is to do practice. Like we'll do the first paper, then we'll do the specimen paper 2, and then I will ask you people to do some complete papers, do the specimen paper 3, do the mock paper, and send me for the marking. Because when you will take my feedback, then only you will be able to identify that whether you are going in the right direction or not. Okay? Let's start the question and let's see that what he's asking in it. I want you all to concentrate on. It is 1st July 2005. You are a manager in the audit department of Atlanta & Company, a firm of chartered certified accountants. You are working on the audit of the RIC Group, which has a financial year end 30th September 2005. The group, a listed entity, offers an international television network with over 10 million subscription members in 8 countries. So this was a brief introduction that in what firm you are working and what the client is doing. Okay, normally this first screen is not very much useful. The following exhibits are available on the left-hand side of the screen. Provide information relevant to the question. Partner's email, background information, selected financial information, component auditor, an extract from the audit strategy document prepared by Negan Associate, the component auditor, which audits one of the group subsidiaries, potential new subsidiary, and then we have to use the exhibits. So this first screen is just a summary that what we'll be looking at throughout the question. So let's start with the first exhibit, which is partner's email. I want you all to concentrate on it and listen to me very carefully so that you people can understand it in a better manner. To audit manager, from Carol Morgan, audit engagement partner, subject audit planning for RIG Group, date 1st July 2005. I have provided you with some information in the form of number of exhibits, which you should use to help you with the planning of the audit for RIG Group for the financial year end 30th September 2005. Based on the analysis I have done on the industry, it is appropriate for overall materiality to be based on profitability of the group, as this is the focus for the investors. Now, as you know, that the materiality based on profits is 5% of PV. So he has made it clear that the materiality level will be based on profits. Now, I require you to prepare briefing notes for my use, in which you, Part A, using the information in all exhibits, evaluate and prioritize the significant audit risk to be considered in planning the group audit. And this is a requirement of 21 marks. Biggest requirement of the entire exam paper. Okay, so we are just reading the data, and now we have found that our first requirement is relating to audit risk, okay, which is of 21 marks. Using the information provided in Exhibit 4, evaluate the extract from the component auditor strategy, commenting on the audit strategy responses and ethical matters relating to the issues identified, and design the principal audit procedures which you will instruct the component auditor to perform on the sale of property to group CEO. Part C, using Exhibit 5, discuss whether it is appropriate for a joint audit to be performed on Mikon Company, commenting on the advantages and disadvantages of joint audit engagement. So 21, plus 728, okay, plus 634, and plus 640 marks. 10 marks are professional marks, which will spread throughout the question, in which the examiner expects that you will use proper communication, proper format, good analysis, good evaluation. Okay? So, just have patience. Listen to me carefully while we develop the approach. Okay, now let's look at the exhibit 2, which is related to background information. The group started to offer internet streaming service for films and TV programs 10 years ago. The group business model is to acquire licenses for films and TV programs, and customers pay a monthly subscription fees to access them and watch online. The group has a subsidiary in each country in which it offers its subscription service. Atlanta Company, all of the subsidiaries, with the exception of Darrell Company, one of the group's foreign subsidiary, which is audited by a local firm called Negan Associates. Now, if you read the requirement, our first requirement is relating to audit risk. And you all know that a different component auditor, Darrell Company, is an audit risk for us. Now, many students ask me that, sir, whether we should write the risk while developing the answer, or we should write the risk at the end. Like first we read the entire question and then we write the risk. My advice would be that it is better that you write the risk along with reading. And if you find any additional information, since the paper is computer-based, you can go and edit it. Since the paper is computer-based, you can go and edit the data. It's not an issue. Like what I mean to say is that since I read here that there is a subsidiary, Darrell Company, which is audited by a different firm called Negan Associate. So you can say that there is a different component auditor. Now, when there is a different component auditor, it is an audit risk because we have to rely on its work. So it is an audit risk. But students say that, sir, maybe while we read the entire question, we may find more information also relating to this. So what I'm saying is that since the exam paper is computer-based, if you find any additional information, you can just go and edit the point. Okay? While we develop the answer, you will be able to understand. Now, we have to respond to the instructions in the email from the audit engagement partner. Professional marks will be available for demonstration of skills in communication. In question number 1, he expects communication also. In question 2, 3, he only asks for analysis and evaluation, skepticism and judgment, and commercial acumen. Because in question 1, we have to develop an email. Okay, so let's develop the answer. Listen to me carefully. We are writing question number 1. Okay, now it's Rick Group. Question number 1, Rick Group. Okay, now we are preparing these briefing notes. The heading is written here on the file also. We are preparing these briefing notes. What you can do is that you can simply copy paste this data. Listen to me how I develop. Okay, now what you will do is just listen to me how I develop it. To, from, subject and date. What you have to do is that you will change this from to, because you are responding to him, and you will move it above and you will change this to from. Okay, we were written the email, we got the email from Carol Morgan. Now we are responding it to Carol Morgan. So we changed this from to 2 and we moved it up. Okay. And earlier it was to the audit manager. Now the audit manager is responding. Okay. So we just changed the to and from. Now we will write the introduction. Now see, it's a uniform introduction which you use always. So see how I develop it. In relation to audit planning for RIG group, just change the name of the company. Other wording will remain same always. In relation to audit planning for RIG group for the year ended. Now what is the year end? You can see here for the year ended 30th September 2005. For the year ended 30th September 2005, following information is relevant for evaluation of. Now just look at each of the requirement. The first requirement is audit risk. The first requirement is audit risk. So I will say for evaluation of audit risk, comma. The second requirement is evaluate the extract from the component auditor's strategy. So the second requirement is evaluation of component auditor's strategy, comma. Third requirement is principal audit procedures in relation to sale of property. Principal audit procedures in relation to sale of property to Group Chief Executive Officer. And the third requirement is, the last one, the fourth is, whether it is appropriate for joint audit to be performed on Mikon company. Okay. And appropriateness and evaluation of appropriateness of a joint audit to be performed on Mikon company. See what I have done is, it's very easy to develop this introduction. Okay, since there are marks for communication, in the exam, so you have to make sure that you made a proper format. What you have to do is you have to just change the name of the company. You have to change the year end every time. And from here, you have to pick up the keywords from every requirement. Evaluation of audit risk, evaluation of component auditor strategy, principal audit procedures in relation to sale of property to Group Chief Executive Officer, and evaluation of appropriateness of a joint audit to be performed on Mikon company. Okay, now you will start with the first requirement. Okay, you have to start with the first requirement, which is evaluate and prioritize the significant audit risk to be considered in planning the group audit. So we are starting with part A, which is audit risk. Okay, so now we will start with each of the audit risk. And here it was the first audit risk where one of the company, exception of Darrell company, one of the group's foreign subsidiary, which is audited by a local firm called Negan Associate. Okay, so here we'll write the first audit risk, which is different component auditor. Okay, one of the group subsidiary, one of the RIG group subsidiary is audited by a different component auditor, Negan Associate. Okay, this creates an audit risk for our firm being a group auditor. Okay, this creates an audit risk for our firm being a group auditor. Why does it create an audit risk for us being a group auditor? If Negan Associates fail to perform its audit work on Darrell Company, which is one of the group's subsidiary, then it will affect Atlanta companies. Then it will affect Atlanta Company, which is the name of our firm. Then it will affect, or you can write directly our firm. Then it will affect our firm's group audit activity. Okay. If Negan Associates fail to perform its audit work on Darrell Company, or you can write it with quality. Okay. Negan Associate is one of the component auditor. If Negan Associates fail to perform its audit work on Darrell Company with quality, which is one of the group subsidiary, then it will affect our firm's group audit activity of entire RIC group. Okay. Further, any delays caused by Negan Associates in component audit work will also affect group audit deadline. Okay. See, what you need to understand is, I always say to my students this, that it's very easy for me to just open the examiner answer and read the examiner answer with you people. But then you will never be able to understand the approach of developing the answer. What I do is that I read the question with you people. Then I think like you people. That, okay, what might be the errors which you people can do? And then we develop the answer. The reason of doing this is that I want you people to have a confidence or an approach that how you have to deal with the exam paper. Okay, so see, in the exam, if we will look at the component auditor, what we'll do is we'll develop one of the RIC group subsidiaries audited by a different component auditor, Negan Associate. Now, there are two issues in relation to it: quality issue and deadline issue. This creates an audit risk for our firm being a group auditor. If Negan Associate failed to perform its audit work on Darrell Company with quality, which is one of the group subsidiary, then it will affect our firm's group audit activity of the entire RIC group. Further, any delays caused by Negan Associate in component audit work will also affect group audit deadline. Now, one thing which you have to take care. In the professional marks, the examiner says that just don't identify the issues, also give the solution. Our firm, Atlanta Company, should have communication with Negan Associates in relation to Darrell Company audit. So that issues in relation to deadline and quality of audit are identified at planning stage and they are dealt appropriately. Now, this is the new thing which the examiner wants. That while you develop a risk, also give a solution to it. Now, earlier, if you read the examiner answer, he writes the solution earlier also. But now in the professional marks, he has made it clear that if you will not write the response to the risk, I will deduct your marks. So what he wants is that while the student identify the risk, he should also give the response to that risk. That now what should be the auditor's approach? Let me repeat the things. I know that things get boring sometime, but see, it's the preparation approach. This is the approach with which 10 of my students have secured nationwide position. I go through the entire question and we develop each and every point. Because when I teach this development of the points, then only students can understand their errors. We made the format of the briefing notes because in question 1, there are marks of communication. Then we developed the introduction, which was just a simple trick. Just change the name of the group, gerund, and relate the requirements. Then we wrote the first audit risk, which was different component auditor. Okay. One of the RIG Group subsidiaries audited by a different component auditor, Negan Associates. This creates an audit risk for our firm being a group auditor. Because if the component audit work is not done properly, then it will affect the group audit quality also. If Negan Associate fails to perform its audit work on Darrell Company with quality, which is one of the group subsidiary, then it will affect our firm's group audit activity of entire RIG group. Further, any delays caused by Negan Associates in component audit work will also affect group audit deadline. Now, what should be the response? Our firm, Atlanta Company, if you have forgot the name of our firm. See here, it's written, our name of firm. Our firm is Atlanta Company. Okay. Our firm, Atlanta Company, should have communication with Negan Associates in relation to Darrell Company audit so that issues in relation to deadline and quality are identified at planning stage, or you can say issues in relation to deadline and conduct of audit are identified at planning stage and they are dealt properly. We can discuss the high risk areas, we can discuss the audit activity process and things like that. Okay, I hope that you people are getting it. And now see one last thing. The examiner normally considers one audit risk for 3 marks. But I advise my students that while you develop a risk, always think it of 2 to 2.5 marks. Don't think of more than it. If you calculate materiality, then you will get 1 separate mark. Otherwise, we consider this risk for 2 marks. The reason being is that we will write more risk. Okay, if you will consider 1 risk for 3 marks, you will write 7 risk in 21 marks. But what we will do is that we, instead of writing 7 risks, we will write 8 or 9 risks. So that what the benefit will be, that if we will be making some error in any point, or if the examiner will be deducting our marks in any point because he may not consider our point as impressive, some extra points, some extra audit risk can cover you and you can get a credit there. Like for example, if the examiner considers that this risk is of 2 marks, not of 3 marks, so he'll give us 2 marks for this point. So if we will write 8 or 9 points instead of 7, so we can cover our marks. Okay, things will get more clear as we develop the answer further. So we were here on the background information. Okay, so all companies within the group have the same financial year, and with the exception of Darrell Company, which reports under local accounting standards, the group companies all use IFRS as their financial reporting framework. So there is one more issue, that Darrell Company is reporting under local accounting standards. So for the group audit purpose, we need to translate its financial statements according to IFRS. So obviously this is also an audit risk. Now you people must be thinking that why the sir is not thinking about the significance of the risk. Because it was written very clearly in the email that evaluate and prioritize the significant audit risk. So what we will do is that once we will write all the risks, then we will cut paste the risk and we will make them prioritize. We'll write the significant risk first and then we'll move towards the less significant risk. Okay, so now we will write local reporting framework. Now, one of the group subsidiary, Darrell Company, reports under local reporting framework. whereas entire group follows IFRS as their reporting framework. This creates a concern for group audit activity. Why it creates a concern for group audit activity? Because we need to translate the Darrell company accounts according to IFRS. And obviously, then there will be component audit issues also, because there can be differences between the local reporting framework and the IFRS. This creates a concern for group audit activity as Darrell company financial statements need to be translated under IFRS, as there can be differences between local reporting framework and IFRS. Okay, and obviously there can be additional audit work also which can get involved. Okay, additional audit work will be involved while Darrell company financial statements are translated as per IFRS. Okay, because there can be different valuation techniques, there can be different judgment techniques in the local reporting framework and the IFRS. Okay, so these are small risks which were 2 marks. Okay, so which reports under local accounting standard, Darrell company which is reporting under local accounting standard. So obviously there is an issue that when it is reporting under the local accounting standard, maybe there are differences in the IFRS and the local accounting standard. So the first audit risk was different component auditor. Okay, then second issue was that one of the group's component, Darrell company, is reporting under local accounting standards. So we need to do the translation. This creates a concern from group audit activity, as Darrell company financial statement need to be translated under IFRS, as there can be differences between local reporting framework and IFRS. So additional audit work will be involved at the end of the Negan Associates being a component auditor, and also for the group auditor, Atlanta company. Let's look forward. Matters relevant to audit planning. Following a discussion between the group audit engagement partner and a representative of the group audit committee, several matters were noted as relevant to audit planning. In January 2005, a legal case was initiated against the group by Glenn Company, a film production company. Glenn Company claims that the group has infringed copyright by streaming a film in specific countries for which a license has not been acquired. The group insists that film is covered by a general license which was acquired several years ago. The group finance director is not willing to recognize the legal claim within the financial statement, as he is confident that the claim against the group will not be successful. And he does not want to discuss it further with the audit team, emphasizing that there is no relevant documentation available for evaluation at this time. Now, since there is a legal case initiated against us, it creates a present obligation. Now, the chances of outflow need to be evaluated by the legal team, not by the finance director. And the approach of the finance director of not discussing the issue is not good. Maybe he is hiding something in this regard. Auditor has to increase his skepticism level, and this attitude of the finance director of not discussing the issue with the audit team need to be highlighted to the senior management and to the audit committee, because it's a significant issue since the group auditor is not discussing the claim, legal case. Rig Group is facing a legal claim. So as per IAS 37, the present obligation do exist. Okay. RIG Group should consider impact of legal case in its financial statements as case filed against the company creates a present obligation against the company. Okay. Chances of failure in legal case need to be evaluated by legal team. If chances of outflow, or you can say if the chances of failure are probable, then a provision needs to be recognized in financial statements. Whereas if chances of outflow are possible, then a disclosure may be required. Amount of outflow, amount of claim, and possible outflow also needs to be determined. Otherwise, a disclosure note will be required if chances of outflow are at least possible. Okay. Now, if I just give you a revision of IAS 37, as per IAS 37, if a claim is filed, it creates a present obligation. Now, if the chances of outflow are possible, you need to make a disclosure. If they are probable, you need to book a provision. If you cannot determine the amount of claim, then you have to give a disclosure. Because if you cannot determine the amount, you cannot book a provision, but at least a disclosure will be required. Amount of claim and possible outflow needs to be determined. Otherwise, a disclosure note will be required if chances of outflow are at least at the possible end. Okay. Finance director's approach of not discussing the issue and failure to provide relevant documentation is not appropriate, and it should be discussed with senior management. Okay, so RIG Group has to consider, as per IAS 37, should consider impact of legal case in its financial state. As case filed against the company creates a present obligation against the company. Chances of failure in legal case needs to be evaluated by legal team. If chances of outflow are probable, then a provision needs to be recognized. Whereas if chances of outflow are possible, then a disclosure may be required. Amount of claim and possible outflow needs to be determined. Otherwise, a disclosure note will be required. See, while I develop the answer, I evaluate the different possibilities. Like if this happens, then what we'll do? If this happens, then what we'll do? Now, these are the professional marks. What the examiner says is that when you write a risk, when you develop a point, you should demonstrate your ability to evaluate. You should demonstrate your ability to communicate. Now, what is evaluation? That you should be able to think different aspects. You should be able to think about different dimensions rather than just sticking to one aspect. Think about, like, if it's possible, then what will happen? If it's probable, then what will happen? And then he says that also write the response. That, okay, if this is the risk, then what should be the response? What we should be doing about it? Okay? I hope that you people are getting it. Now, Darrell Company. Negan Associates provide the audit service to Darrell Company, one of the group's foreign subsidiaries. Darrell Company is one of the group's larger subsidiaries. It is a listed company in home jurisdiction with total assets of $140 million. Due to internet service issues where Daryl company is based, a significant number of customers have cancelled their subscription and the company is projected to make a loss this year. Daryl company is one of the subsidiary which does not follow IFRS. As in local jurisdiction, the company must follow the local accounting rules. It uses the same currency as the rest of the Daryl company was acquired several years ago, and the goodwill of $38 million is recognized in the group financial statements in respect of the company. Now, while you read this information about Daryl company, you can find some things. Like you are given with the total assets of the Daryl company. If I look at other exhibits, like here is one more exhibit, which is selected financial information. I can find the total assets of the group, which are $780 million. So what I can do is that I can calculate the materiality of the Daryl company. Its assets are $140 million, whereas the entire group's assets are $780 million. So if I calculate the materiality of this subsidiary, like it's 140 million divided by 780 million. So it is 17.9% of the total assets. So you can say that this subsidiary is a material subsidiary to the group. So what you can do is that here where you wrote a risk of different component auditor, you can add a point, you can add a comment here. Daryl company is one of the significant subsidiary of the group, as its assets of $140 million represent 17.9% of total group assets. Now, this is what you do. While you read the entire point, you pick up different information. You pick up different information and you add in your points. Like we wrote this risk while we were at the start of the question, but when we read it here, we said, okay, we are given with the information about assets. So we said, okay, we can put some point here. Then due to internet service, where Daryl company is based, a significant number of customers have cancelled their subscription and the company is projected to make a loss this year. So you can say that this is an impairment indicator for Daryl company. Daryl company was acquired several years ago and a goodwill of $38 million is recognized in the group financial statement in respect of the company. So you can add an audit risk here, which can be related to impairment of the goodwill. Because if the performance of the Daryl company is falling, then the goodwill recognized in the group books, in the group accounts, need to be tested for impairment. Okay? Impairment of Daryl company's goodwill. Okay? Rig Group should perform, or in case of goodwill, we perform the impairment review every year also. Okay? Rig Group should evaluate Daryl companies, should evaluate goodwill of $38 million recognized in respect of Daryl company, should evaluate goodwill of $38 million recognized in respect of Daryl company for impairment. Okay? Impairment review, or you can refer the IS, as per IS 36, goodwill should be tested for impairment every year. In case of Daryl company, chances of goodwill impairment are greater as Darrell Company is expected to make a loss this year. Why it is expected to make a loss this year? Due to significant number of customers have cancelled their subscription. And why is it? Due to internet issues. Okay? Due to loss of several customer subscriptions during the year. Okay, so RIG Group should evaluate goodwill of $38 million recognized in respect of Darrell Company for impairment. As per IS 36, goodwill should be tested for impairment every year because this is one of the assets which is not depreciated or amortized. In case of Darrell Company, chances of goodwill impairment are greater as Darrell Company is expected to make a loss this year due to loss of several customer subscriptions during the year because of those internet issues as it is written in the question, due to internet service issues. Okay, so if you want, you can write it here because of internet service issues. Okay, now apparently this goodwill impairment review is not done. Apparently this goodwill impairment review is not done, so you will comment that what the issue management has done. RIG Group management has not performed the impairment review because there is no information yet where we can find that whether any such review was performed. Has not performed the impairment review, which will overstate goodwill asset and the profits of the group. Okay, goodwill recognized of $38 million represents how much? The total assets of the group are 780. So 38 divided by 780, it's 4.8%. Represents 4.8% of group assets, therefore material to financial statements. Now, some students may be thinking that in the question, he said that materiality will be based on profitability. But the materiality based on profitability is used for income statement items. Here we are talking about the balance sheet items. For balance sheet items, we use asset as the main threshold. Okay. So the first audit risk here was different component auditor. We commented that Darrell Company is audited by a different auditor, then local reporting framework, then legal case, and then impairment of Darrell Company goodwill. When you calculate the materiality, that materiality will give you 1 mark. You all know that. 1 mark for materiality. But maximum 3 to 4 marks are available for materiality calculation, not more than that. Okay, so how many risks we have written? 1, 2, 3, and 4. So we have written risk, 4 risks. So if we give 2 marks for each of the risk, it's like 8 marks. And we have calculated materiality 1 time here and 1 time here. So whenever we calculate materiality, we'll get 1 mark for it. So 4 risk, 8 marks, and we have calculated materiality 2 times. So we have secured 10 marks till now. We haven't done the prioritization work yet. We are just reading the question and we are developing the risk as we find them. Okay, let's move forward. Darrell Company was acquired several years ago and goodwill of $38 million is recognized in the group financial statement in respect of the company. Let's move to the next exhibit if there is no other information. Okay, yes. So there is no further information. Now here it's selected information, the exhibit 3. Let's look at it. So this is the financial data group revenue. It has increased from 780 million to 980 million. There is a note 1. So let's go and read the note 1. The group's main source of revenue is from monthly membership fees. Members are billed in advance at the start of their month monthly membership, and revenue is recognized when the bill is sent to the customer. Now, here there is an error. We bill the customers in advance. We bill the customers in advance, and we book the revenue when we send the bill. This is wrong. As per IFRS 15, revenue can only be recognized when the performance obligation is performed. The obligation is not performed at the start of the month. It is performed at the end of the month, when you give the service for the entire month. So recognizing the revenue at the start of the month is not right, first thing. And if we can say that, like, for example, even if we are booking at the start of month, it will get settled at the end of the month. So what's the issue in it? The issue is that, for example, if the customer don't pays the bill and you stop their subscription, then obviously the revenue you booked was wrong. And as per IFRS 15, the simple principle is that you can only book the revenue when the obligation is performed. You are billing the customer at the start of the month, and you cannot recognize the revenue at the start of the month because you haven't given the performance yet. Okay, all of whom pay by the credit card. So the first issue here is that the revenue recognition approach is wrong. Okay, the revenue recognition approach is wrong. Now, this is an accounting issue, so you can simply comment on the correct accounting treatment first. As per IFRS 15, RIG Group should recognize revenue when performance obligation is performed and service is given to customer. Okay, revenue for each month subscription should be recognized at end of month when service is performed, when service is given, and performance obligation is completed. Because we have given him the service for the 1 month, and then we can only book the revenue. So this is the correct treatment as per IFRS 15. Management of RIG Group recognizes revenue at start of month when they send the bill. This treatment is wrong as per IFRS 15, and it will overstate their revenues. Okay, because if you will book the revenue at the start of the month, this will overstate your revenues. Now, some people can argue that if we look at the activity of the complete month, it will not create an issue. Because even if we have booked at the start of the month and our year end, obviously the year end is the end date of a particular month. So it will not be an issue. But you also need to think that if some customer cancels their subscription, or he does not honor the payment, or if the card gets declined, then the revenue book will be overstated. There will be cut-off issues also. So as per IFRS 15, RIG Group should recognize revenue when performance obligation is performed and service is given. Okay. Revenue for each month subscription should be recognized at end of month when service is given and performance obligation is complete. Now, this is a significant error which they are doing. So this error, this should be discussed with the finance director. And this wrong accounting treatment should also be discussed with the senior management if the finance director don't adjust it. Okay. Significant error. Significant error in revenue recognition approach should be discussed with finance director and senior management, and it should be corrected by RIG Group. Okay, because it's a major issue. So see, when we write a risk, we also give the response that, okay, you should be doing this. Okay, I hope that you people are getting it. Okay, so let's read further. Now, the price of a regular subscription has remained at $8.2 per month throughout 2004 and 2005. Occasionally, the group offers a free trial period to new customers. This year, the group also introduced a new premium subscription package, which allows customers to add 2 family members to their subscription for an additional fees of $5 per month. Now, if we look at it here, our group revenue is 980 million. Now, these are our number of subscribed customers. You can look at it here. So what I can do is that if I divide 980 million divided by my number of subscribed customers are 10.5 million. So this gives me that my yearly revenue per customer is $93. Now this is annual. Don't get confused by looking at per month revenue. My annual revenue per customer is $93 in the current year. But if I look at the previous year where my group revenue is 780 million and number of subscribed customers is 8.070. Okay, so it is $96.6. Now what we are seeing here is that revenue per customer is falling. Listen to me. The revenue per customer has declined from $96 to $93. Our revenue per customer is declining. Now, this is something which is odd because during the year, the group introduced a new subscription package under which the customers have to pay extra $5. Okay? The customers pay an extra fees of $5. So the revenue per customer should have increased. Per subscribed customer revenue should have increased. But apparently that revenue per customer is declining. The price of regular subscription has remained at $8.2. Now see, while I develop the answer, maybe you will be able to understand in better manner. Trend in revenue. Trend in revenue per customer. Revenue per customer has declined from $96.6 to, now how did I calculate this $96.6? 780 million is the group revenue divided by 8.070 because I'm converting in million. So it's 96.6. Last year it was 980 million divided by 10. This year it's 980 million divided by 10.5 million customers. So it's $93.3. Has declined from $96.6 to $93.3. Okay, this trend in decline in revenue per customer is abnormal. Why is it abnormal? Because subscription price per customer has remained constant during the year at, here it was written, the price of regular subscription has remained at $8.2 per month throughout 2004 and 2005. Okay, the trend in decline in revenue per customer is abnormal because subscription per customer has remained, because regular subscription price per customer has remained constant during the year at $8.2 at $8.2 per month throughout 20x4 and 20x5. Revenue per subscribed customer should have increased in 20x5 due to premium subscription model introduced by Rick Group. Okay, we have introduced the concept of premium subscription, where every customer has to pay extra $5 and get a subscription for their family. So the per subscription revenue should have increased. Revenue per customer should have increased in 20x5 due to per subscription model introduced by Rick Group. Okay, our firm should investigate this decline in revenue per customer. Now, this is the action which you should be taking. Now, is there any reason for it? If you look at it here. Now, here it is one thing. Occasionally, the group offers a free trial period to new customers. So maybe the revenue per customer may have declined due to this free trial period. So if you find any possible counter argument, you should refer that also. What you need to understand is, if you remember the professional marks lecture, which I gave in the previous class, what the examiner wants is that the student should evaluate the data. He should think in all the directions. Decline in revenue per customer may be due to free subscription offers given by Rick Group to new customers. See, as I told you at the start, it is very easy for me to teach like any other tutor. I just open the examiner answer and I read it with you people. I say, okay, you understand this. Okay, good. It's okay. But then you will never be able to understand the drafting approach. I write the answer with you people. I think like a student, okay, this is the point. I can add this. I can write like this. Okay. So try and understand the approach, that how I identify the data. Because many students ask me this, that sir, how come you identified the data? We were not able to find this thing. That's why I'm writing like an answer. I'm thinking like a student. Okay, this is the point. I can pick this data. I can pick this data. Okay. So revenue per customer has declined from $96.6 to $93.3. Now you must be thinking that how my mind went towards that. So look here. He himself referred the price of the subscription. Then we read group revenue, and then at the very front of the screen, we can see the number of subscription customers. So we just calculated the per customer price. Then here it was written that the price has remained constant throughout the year. Now, when we calculated it, it declined from 96 to 93, which is abnormal, which is questionable. So this trend in decline per revenue is abnormal because regular subscription price per customer has remained constant during the year at $8.2 per month throughout 2004 and 5. So in both years, the price was constant. Then why it's declining? Now we said that revenue per subscribed customer should have increased. Why should it have increased? Because the company has introduced some concept of premium packages. The price should have increased rather than falling. So now again, it's questionable. But then we said that occasionally the group offers a free trial period to new customers. So maybe a customer enjoyed free trial period in the first 3 months. Just think about it. He enjoyed free trial period in first 3 months, and then he started the subscription. So he became a customer. He became our one customer, but he didn't pay for the entire year revenue. Maybe due to that reason, the per customer revenue is declined. So now see, these are the professional marks. If you remember my professional skills lecture, the previous lecture, you have to give the suggestion. So we said that, okay, what our firm should be doing, we should be investigating it. And then we thought about the countermeasures also. Like maybe this is the justification. Now, this is what the examiner wants from you people. That students should have good evaluation. He shouldn't be just thinking in one direction. Like what students do is they say that since we are identifying the risk, we will only look at negative things. No, then your objectivity is sacrificed. You are not evaluating independently. You should think either way. Okay, so let's move forward and let's look if we find any further risk. Then we are provided with operating profit. It was $70.2 million previous year. This year it's an increase to 78.4. Then our PBT. Then we have total assets. In intangible assets, there are some licenses. Then see, the intangible asset, the goodwill balance was 135 million last year. And this year also it's 135 million. This constant balance shows that impairment work is not done. No impairment is recognized. Okay, so we'll look at it while we read it. The group acquires content licenses per title in order to stream films and TV content to subscribers. The content licenses are each for a fixed time period, varying between 3 and 5 years. The group capitalizes the cost per title as an intangible asset. Group policy is to amortize license over a 5-year period. The finance director justifies this as being the most prudent accounting treatment. Now, obviously, this is wrong. If a particular license is of 3 years, why are you amortizing it for 5 years? Now, I will identify 2 risks in this point. One is wrong amortization, and then I will say that here the finance director himself is an audit risk because he is continuously doing the wrong treatments. If you remember the legal case issue, he was not recognizing and he was not willing to discuss. And here it is clearly written that the content license varies between 3 and 5 years. Then why are you amortizing all of the licenses at a fixed period of 5 years? And then he's saying that this is the most prudent treatment. Why is it the most prudent treatment? If for a license of 3 years, you are using the life of 5 years, this is not a prudent treatment. Prudent should be that you should keep life less so that there will be greater amortization expense. So it's simple that the amortization booked on these licenses is wrong. Okay. And here you can also write a risk that finance director is using a wrong approach. Maybe he lacks expertise or maybe he's biased towards increase of profits. Okay, so currently what we are doing is that we are just drafting the points. At the end of the question, we'll do the prioritization work. So now, amortization of licenses. RIG group should amortize each of its license recognized according to its respective license period, as licenses vary from 3 years, as license periods vary from 3 years to 5 years. Finance director's approach to amortize all licenses at fixed period of 5 years is wrong. I would say it is not correct, is wrong. It will lead to lesser amortization being charged on some of the licenses which have period of less than 5 years, because it's clearly written that the license period vary from 3 years to 5 years. Finance director's approach to amortize all licenses at fixed period of 5 years is wrong. It's not correct. It will lead to lesser amortization being charged. Because if the license period is 3 years, you should be dividing it by 3, but you are forcefully dividing it by 5. Okay? It will overstate profits and license asset of RIG group. Okay? License asset recognized worth how much? It's worth $580 million. And your total assets are $780 million. So obviously, it's a significant asset. Okay, and it is obviously material also. So 580 divided by 780 million, it's like 74.3%. Obviously, we are not given about the accurate amortization expense amount. If some student want, he can calculate the estimated difference, but we are not given with the breakup that what is the breakup of the 3-year assets and what is the breakup of 5-year assets. So you can say worth $580 million. Recognized worth $580 million represents 74.3% of group assets, therefore material to financial statements. Okay, so amortization of licenses is obviously an issue. Amortization of licenses is obviously an issue. So RIG Group should amortize each of its license recognized according to its respective license period. So if the license period is 3 years, you should be using 3. If it's 4 years, you should be using 4 years rather than using a single life of 5 years. Okay, it will lead to lesser amortization being charged. So if you look at the question till now, the first risk was of different component auditor, that one of the group subsidiary Darrell Associate was audited by a different company. Then there was issue of local reporting framework, that Darrell company follows local framework. Now there can be issues like the local framework may have different estimation techniques or different recognition techniques. So we have to translate the entire FS. Then there was legal case issue, then impairment. 5th one was revenue recognition, 6th one was strand, and the 7th one was amortization of license. Okay, so what you need to understand is that even if I follow a 2-mark approach per risk, I've written 7 risks, so it means 14 marks. Then I've calculated materiality almost 3 times. One was in this amortization of license, then there was in this goodwill point, impairment of goodwill. Then we calculated materiality of the entire Darrell company. So 17 marks. Then we use some calculations in the trend, because if you know, for each materiality, you get 1 mark. For each of the calculation, like per customer revenue, trend, you will get 0.5 marks for each of the calculation. So almost we are done with 17 to 18 marks. If you look at the answer, we are almost done with 17 to 18 marks because we have written 7 marks. 7 marks into 2, it's like 14 marks. Then we have calculated materiality 3 times, so it's like 17 marks. We have done some calculations of the trend. Okay, so the paper is very easy. What you need to understand is that you should not be creating a burden on yourself. Don't get pressurized by the question. Read it in the relaxed mode, develop the risk. Don't worry about the entire scenario. For the professional marks, just use better communication. For the professional marks, just try and write the responses that what you should be doing. Evaluate the points. Obviously, in the accounting issues, you tell the correct treatment so it completes the evaluation issue. Okay. The prioritization of the risk, we'll do it at the end. Once we write all the risk, we'll just cut, paste, and move them up and down. Clear? I hope that you people are getting it. So, let's come back to the selected financial data. Let's go back to the exhibit 3, which is selected financial information. Now, we are just done with the note 2, which was on amortization of the license. Now we are moving towards the note number 3. I want you all to concentrate on it. Goodwill arising on business combination is tested annually for impairment in accordance with IS 36. Due to the strong performance of the goodwill, no impairment of goodwill has been recognized in recent years. Maybe the entire group is performing well, but Darrell company itself is creating a loss this year. So we identified here in the point of impairment of Darrell company goodwill that RIG Group should evaluate goodwill of $38 million recognized in respect of Darrell company for impairment. As per IS 36, goodwill should be tested for impairment each year. In case of Darrell Company, chances of goodwill impairment are greater, as Darrell Company is expected to make a loss this year due to loss of several customer subscriptions during the year because of internet service issue. Now, Rig Group management has not performed impairment review. So you can add the word correctly here, or you can say that maybe the Rig Group management has not recognized the impairment on the basis of the entire group performance, which will be wrong. We should look at each of the components separately. Maybe the entire group is performing well. Maybe the entire group is performing well. But if the Darrell Company is not performing well, then we have to recognize impairment on Darrell Company specifically. So Rig Group management has not performed the impairment review correctly, or maybe they mix the performance of Darrell Company with the entire group performance. Okay. So we have already stated a point in this regard. So if you look at this, note 3, we already wrote a point on it. So revenue, operating profit, PBT, all of them is. Now in Exhibit 3, we are done with the entire selected financial information. Okay. Now we have one risk which we identified, which was in relation to the finance director. That the finance director of Rig Group has been imposing the limitation on scope, and he has advocating the wrong accounting treatment at 2 instances, which was in relation to the amortization of the license, where he was saying that using the 5-year life was the most prudent treatment. And if you remember, in relation to the legal case also, the group finance director is not willing to recognize the claim within the financial statement, as he is confident that the claim against the group will not be successful. And he does not want to discuss it further with the audit team, emphasizing that there is no relevant documentation available for evaluation at this time. So we can write an audit risk relating to group finance director. Okay. Approach of group finance director of Rig Group's finance director creates an audit risk, for our firm, because finance director has been imposing limitation on audit work, and has also been advocating wrong accounting treatment. Okay. Now, if the company has a finance director who restricts the auditor's work, or if he lacks competence and he's advocating wrong accounting treatment, this itself is an audit risk for the audit. Okay. Finance director restricted auditors' work in relation to legal claim where he denied to provide further documents and to discuss legal claim filed by, if you remember the name of that company which filed that legal claim, the name of that company was Glen Company, filed by Glen Company. Now, approach of Rig Group's finance director creates an audit risk for our firm, because finance director has been imposing limitation on audit work and has also been advocating wrong accounting claim. Finance director restricted auditors' work in relation to legal claim where he denied to provide further documents and to discuss legal claim filed by Glen Company. It may lead to modification on audit opinion if its impact is material. Further, finance director also applied wrong accounting treatment for amortization of licenses. Okay, he applied wrong accounting treatment for the amortization of licenses. He gave He gave a wrong justification for applying the treatment, for applying the inappropriate treatment, which he said that this was the most prudent treatment by using the wrong life. Okay. Approach of finance director needs to be discussed with senior management, as it may affect the entire audit activity. Further, auditor should increase professional skepticism in relation to claims made by finance director. Now, in relation to the other claims made by the finance director, we should increase our skepticism level, which means we should question greater data. Okay, so we have referred the approach of the finance director points also, but specifically we wrote a risk that finance director itself increases the audit risk. Okay, so approach of the rate group's finance director creates an audit risk for our firm, because finance director has been imposing limitation on audit work. He has been restricting us and has also been advocating wrong treatment. Finance director restricted auditor work in relation to legal claim, where he denied to provide further documents and to discuss legal claim filed by client company. It may lead to modification on audit opinion if its impact is material. Because if you don't provide the evidences and if it is material, then it will lead to modification of opinion. Further, finance director also applied wrong treatment for amortization of license. He gave a wrong justification for applying the inappropriate treatment. Approach of finance director needs to be discussed with senior management, as it may affect the entire audit activity. Okay? Is it clear? So let's move forward. So we wrote a risk in relation to the group finance director. So we are done with this selected financial information. Now we have some information relating to the component auditor, the component auditor's work. The 3 points below are an extract from the audit strategy prepared by Negan Associates in relation to their audit of Darrell Company. Other sections of audit strategy, including audit risk assessment, have been reviewed by the group audit team and are considered satisfactory, so you don't need to consider them. Materiality has been set by Negan Associates in agreement with Atlanta Company at $1.4 million. Now, these are the 3 issues identified by Negan Associates. Payroll. From 1st October 2004, payroll accounting services are provided to Darrell Company by Negan Associates as additional non-audit engagement. Now, this is an ethical issue. Negan Associates audits the Darrell Company and they are also providing the payroll services. Now, if you remember, in the background information, it was written that Darrell Company is a listed company. Now, as per ethical code, providing non-audit services to listed client is prohibited. And services like payroll, which directly affect the financial statement of it, obviously it is a prohibited activity. Okay? But you have a separate requirement in relation to it. If you remember in the partner's email, we have a separate requirement in relation to it. Evaluate the extract from the component auditor strategy, commenting on the audit strategy responses and ethical matters. So we will discuss about this in the separate requirement. Obviously, this is not an audit risk issue. Then audit strategy response by Negan Associate agree the total payroll figure estimated to be $6 million from the statement of P&L to the payroll report generated by Negan Associate. So there is no audit work done effectively. We just picked the report we made while providing non-audit services and we matched it with the FS. We should have at least used a separate team and asked them to audit it. We just relied on our non-audit work and just matched the data. No further procedures are considered necessary. So obviously this was an issue that the audit strategy and the audit work plan is not complete. But there is a separate requirement in relation to it. Then sale of property. Darrell Company sold a small unused building located on the coast to the group's CEO in February 2005 for $50,000. The amount is still outstanding for payment. The group's CEO is planning to use the property as a holiday home. So obviously this is a related party transaction because the group's chief executive officer is a related party of the group. Confirmed $50,000 is included in receivable. No further audit procedures are considered necessary because the transaction is not material to financial statement and local accounting rules do not require disclosure of this transaction. Now this is the problem. That as per local accounting rules, they didn't give the disclosure. But as per IAS 24, the transaction with CEO needs to be disclosed. So if you want, you can refer this incident in the local accounting rules point, the audit risk which we wrote. Like what I will do is, we wrote one point here, which was relating to local reporting framework. Okay. One of the incident or one of the transaction which involved different accounting treatments under local reporting framework and IFRS is transaction with group CEO referred in Negan Associates audit strategy. As per local reporting framework, transaction with group CEO do not require any specific disclosure. Whereas under IFRS, this transaction needs a separate disclosure as it is a related party transaction. So basically what you need to understand is, see, this comment, we added it while we were reading this Exhibit 4. Basically what you need to understand is that the benefit of the computer-based exam is that we can go back at any point of time and we can edit the comment. And this is what the examiner expects from the student, that the examiner takes the student takes a complete evaluative approach. He looks at the entire data of the question. Okay. See, as I told you at the very start of the today's session, that my approach is to think like a student. See, if we are doing exam paper, we'll do like this. We'll read, we say, okay, we should add this comment. We'll go back and we'll add the comment. Okay, so one of the transactions which involve different accounting treatment under local reporting framework and IFRS is transaction with group CEO referred in Negan Associates audit strategy. As per local reporting framework, transaction with group CEO do not require any specific disclosure, whereas under IFRS, this transaction needs a separate disclosure as it's a related party transaction. But we'll be developing a detailed commentary on these things while we will be writing the answer to part B1, where we have to evaluate the audit strategy. Now, since we have to use the audit strategy in requirement B1, that's why I'm trying and avoiding the points in audit risk, because otherwise there will be repetition in my answer. Okay, and then the first transaction was payroll, and the second one was sale of property. There were only two transactions. Okay. Now, so we will cover these while we'll be drafting the part B1 answer. Now let's look at Exhibit 5 if there is anything else. The group is planning the acquisition of a new foreign subsidiary, Mekong Company, which is located in Farland. The negotiations are at an advanced stage, and it is likely that the acquisition will take place in October 2005. Now, our year end is 30th September 2005. whereas this acquisition will take place in month of October. So it will be a subsequent event. Any significant acquisition or disposal of subsidiary in subsequent period is a non-adjusting event. But for non-adjusting events also, we give a disclosure. At least we need to give a disclosure for this non-adjusting event. Okay. The planned acquisition in October 2005 is a transaction after the year end, but it will be a subsequent event because obviously the financial statements will not be issued till that time. Okay. So if you look at it here, planned acquisition of Mirchawala company. Planned acquisition of Mirchawala company in October 20x5 will be a subsequent period transaction for the year end of 30th September 20x5. Okay, acquisition of a significant subsidiary, okay, a new foreign subsidiary which is located in far line. The negotiations are in advanced stage and it is likely that acquisition will take place in October 2005. Acquisition of a subsidiary in subsequent period will be regarded as a non-adjusting transaction to financial statements. Okay, a disclosure note will be required in relation to it in financial statements of year ended 30th September 20x5. Okay, we need to give a disclosure in relation to it. Even it's a non-adjusting transaction, we need to give a disclosure. If it would be an adjusting transaction as per IS 10, then we need to adjust the FS. Failure to give disclosure note will misstate notes to financial statements. Okay, so we need to give a disclosure in relation to it. Then what is he saying? Okay, planned acquisition, that's exhibit 5. The group's audit committee has suggested that if the acquisition goes ahead, due to distant location of the company and the fact that Atlanta company has no offices in Farland, a joint audit could be performed with Mirchawala company's current auditor, Lucille Associates, a small firm of chartered certified accountants. So again, this is a next year's plan because obviously the acquisition is after the year end. Now, if the acquisition goes ahead, then next year we'll go for joint audit, which is obviously not an audit risk for the current year. So we have covered all the exhibits except the exhibit number 4. I didn't pick up any specific risk from exhibit number 4. Reason being that we have a separate requirement, part B1, in which we have to comment on this audit strategy. So if I look at my answer till now, how many risks we have written? It was a 21 marks question. Different component auditor 1, local reporting framework 2, then legal case 3, impairment 4, revenue recognition 5, 6, 7, 8, 9. We have written 9 risks. So if we multiply 9 with minimum side, normally the examiner thinks 1 risk for 3 marks. But we take a minimum side that if each of our risks were 2 marks, then also it's 18 marks. Then we have calculated materiality 2-3 times. We did some calculation work also. So if we give 1 mark for each materiality, our 21 marks requirement is complete. So if you look at the answer, what you need to understand is that while writing the audit risk with the current exam format, with the current professional marks format, what you need to understand is that you have to write the responses also. Like I have tried and written the responses in the maximum possible risk. That, okay, we should do this, this should be our action. Secondly, you should use headings. Then you should have the scale of evaluation. You should be looking at the entire data. Okay, you should be questioning the data. You should be using professional judgment. You should be doing some calculations and you should reach some conclusions. Okay, now we have written all the audit risks. Now what you need to understand is that you should prioritize them, that the significant risk should come first. Like you can say that revenue recognition is a very important risk, because due to wrong revenue recognition, the entire revenue recognition approach of the company will get affected. So you can sort the risk. Okay, you can rank the risk according to their significance. Okay, now since the paper is computer based, so you can just cut paste it. Like you can put revenue recognition first. Then this issue of legal case was also very important. The issue of legal case was also very important. Okay, the claim filed by Glenn Company. Different component auditor and local reporting framework were also important risks. But you can say that the risk which involve materiality, those will be more important ones. Okay, then you can refer this amortization of license. Okay, and this impairment of Darrell Company goodwill. So these are the risks which are more important ones. What I will do is that I will sort the risk. Amortization and impairment, I will move them up after the legal case point. And we cut pasted, the formatting gets out, so don't worry about it. Okay, so I'm just sorting the risk according to their significance. Okay, what you need to understand is that it's a pure judgment area. Obviously, the examiner will give you a bit leverage, but what you need to understand is that we will sort the risk according to the significance, that the significant risk should come first. Like revenue recognition was a very significant risk because it involved the entire company's wrong policy. Then legal case was also a significant risk. Amortization of license, impairment of Darrell Company goodwill. Then trend in revenue per customer was not a very much significant risk because here we just performed our analytical. Group finance director was a big issue. Planned acquisition of Micon Company was just a disclosure note issue. So you can write the point. You can write the point on the finance director here. Okay, so it's your professional judgment that how you rank the risk. But what I did was that since the revenue recognition was a very significant issue, so I wrote it first. Then the legal case matter, because the legal case in this the finance director was also imposing a limitation. Then amortization of license, then the Darrell Company goodwill, then different component auditor issue, local reporting framework issue, group finance director comment, trend in revenue per customer, and then client acquisition. Now here it's a matter of judgment. Like for example, if you used a bit different approach, then it will also be acceptable. But what the examiner expects is that the student should have the ability to prioritize reviews. Okay, like for example, if someone writes the risk of disclosure note on first, so obviously the examiner will say that student is not using a very good judgment. Okay, so if we look at this entire answer, now this was a 21 marks answer. First, we made briefing notes. The format will also give you marks. Then we wrote introduction. And then in audit risk, which was part A, which was of 21 marks, what we did was we developed each of the risks and we try and use professional language. Then we wrote the responses to the risk also. We make sure that we add responses to the risk also. Like the examiner sees in the evaluation and analysis work that not only identifying the issue, also give the responses. Okay, then we prioritize the risk. I hope that you people are understanding. Okay, so once done with the first requirement, which was the biggest one, Now we are moving towards the second requirement, which is part B1, in which we have to evaluate the extract from the component auditor strategy, commenting on the audit strategy responses, and the ethical matters. Now, this is a question of 7 marks. So, part B1, evaluation of component auditors audit strategy. Okay, so now we are moving towards part B1. I hope that you people are understanding. Like we did the first part, audit risk, we'll be following the same approach. We'll pick up each of the requirement and we'll develop the answer. We'll write up the points. The basic purpose is that you people need to understand the approach. That while we develop the risk, we write the responses, we use better language, we try and evaluate the complete scenario. We don't just draft the point from one head, we prioritize the risk. Now we are moving towards part B1, which is evaluation of the component auditors audit strategy. I want you all to concentrate on, okay, which is written here in exhibit number 4, which we just read, but now we'll read it more specifically because we are answering its requirement, okay? So we are looking at the component auditor's strategy since we have to evaluate it. The 3 points below are an extract from the audit strategy prepared by Negan Associates in relation to their audit of Darrell Company. Other sections of the audit strategy, including the audit risk assessment, have been reviewed by the group audit team and are considered satisfactory, so you do not need to consider them. Materiality has been set by Negan Associate in agreement with the Atlanta company at $1.4 million. Now, these are the issues identified. So basically, we have to comment on the issues, evaluate the extract from the component auditor strategy, commenting on the audit strategy responses, and ethical matters relating to the issues identified. Now, if we look at the issues heading, one issue is payroll and one issue is sale of property. Okay, basically 2 issues are given, whereas he wrote 3 points. The problem is that this is an earlier past paper which he has adapted to specimen paper. Now, since he shifted the marks to the professional marks, so the marks for this particular requirement has been reduced. What I mean to say is that earlier in the original paper, this requirement was of 10 marks. But since now in the exam, there will be 10 professional marks, so he's reduced the marks for every requirement. So he has modified the question also. Basically, earlier this requirement was of 10 marks in the original paper. But in specimen, this requirement is of 7 marks because in specimen paper, he has given the professional marks as per the current requirements. Okay, so now we have only 2 issues, not the 3 issues. One is payroll and one is sale of property. From 1st October 2004, payroll accounting services are provided to Darrell Company by Negan Associates as an additional non-audit engagement. So now this is an ethical issue. Okay, now what is the planned audit response? Agree the total payroll figure estimated to be $6 million from the statement of P&L to the payroll reports generated by Negan Associates. No further audit procedures are considered necessary. So what we will develop is that Negan Associates provide payroll services to Darrell Company along with audit work, or along with audit services, or along with annual audit. Okay, this will create a self-review threat, as Negan Associates will be auditing its own work in payroll head while auditing the financial statements. Okay, it is a self-review threat and it is a significant threat. Okay, payroll is a significant amount, is a significant amount, is a significant amount in financial statements. Therefore, therefore, self-review threat will be higher. Okay. Now, as Darrell Company is a listed entity, therefore, provision of non-audit services should be prohibited. Okay, it is not allowed to provide non-audit services to an audit client. Okay, therefore, provision of non-audit services should be prohibited to audit client. Okay, this is wrong as per the ethical standards. Further, payroll amount, payroll head worth how much? $6 million exceeds the materiality level of Darrell Company. What is the materiality level of Darrell Company? Of $1.4 million. Exceeds the materiality level of Darrell Company of $1.4 million. Okay, so this head is material to FS. Only audit work performed was to agree payroll amount in profit and loss with Negan Associates own report. Okay, now this means that no audit work was performed. Okay, additional audit work should be performed by a separate team, to verify that payroll amount calculated by Negan Associates non-audit work team was correct or not. At least you should use a separate team to check it. You should perform some further procedures. I will repeat it again. First of all, it is creating a self-review threat. Negan Associate is the auditor and they are also providing the payroll service. This creates a self-review threat. It's an ethical issue. Then as a listed entity, we cannot provide these services. Okay. Now, the head is material to FS, and above all, what audit you have done? You just match the payroll number in the P&L with your own prepared report. So obviously, this is an insufficient audit work. Effectively, you didn't do any audit. You haven't done any audit. What you have done is, you just check the number in the P&L with the report which you prepared yourself. At least you should use a separate team and get further procedures performed so that the audit work is justified by some extent. Effectively, we haven't done any audit work. So the planned audit response, audit strategy response is insufficient. Okay. Additional audit work should be performed by a separate team to verify payroll amount calculated by Negan Associates non-audit team work. Okay, basically you should use a separate team for non-audit work and the audit work. Okay, so additional audit work should be performed by a separate team to verify that payroll amount calculated by Negan Associates non-audit work team was correct or not. So we have to evaluate the strategy prepared by Negan Associates. I hope you are getting it. Then if I go further, there are only two issues. As I told, here he wrote that there are 3 points below. But in reality, the question we got has only 2 points. Why? Because in the specimen paper, the examiner has changed the paper because he has reduced the requirement marks and he has shifted them to profession. Now, sale of property. Darrell Company sold a small unused building located on the coast to the group's CEO in February 2005 for $50,000. The amount is still outstanding for the payment. The group CEO is planning to use the property as a holiday home. Now, what is the planned audit work? Confirm $50,000 included in receivable with current assets, which means he only verified the receivable balance. What about the disclosure? What about verifying the gain or loss? The market value of the asset, because you have to give all of this in the disclosure note. No further audit procedures are considered necessary because the transaction is not material to the financial statement, and the local accounting rules do not require disclosure of this transaction. Now, planned audit response in relation to sale of property to group CEO is insufficient as transaction is considered as immaterial in it. Planned audit response in relation to sale of property to group CEO is insufficient as transaction is considered immaterial in it. It is a related party transaction. It is a related party transaction, and therefore it is qualitatively material to financial statements. Okay, so first of all, it is material to FS. Are you getting it? As per IS 24, a disclosure note in relation to this transaction needs to be given. Okay, even if the Darrell Company FS is prepared as local reporting framework, but for the group FS, we need to comply with IS and IFRS. Group auditor should require Negan Associates to perform audit work in accordance with IFRS requirements also. Okay, a disclosure note will be required in financial statements, which will include detail about transaction, market value of asset, okay, whether transaction was arm's length or not, due date of remaining amount, of balance amount. So a disclosure in relation to it should be given, and it is the requirement. Are you getting it? Then if you look at the planned audit work, it only confirms that $50,000 is included in the receivable. There is no audit work done to verify the market value of the asset. It needs to be disclosed. There is no audit work done in relation to the due date of the balance. There is no audit work done to verify that whether the transaction was done in reality or not. Okay? Planned audit work fails to verify market value of asset. It will be required in disclosure of related party transaction. Okay. Further, due date of balance amount, that when the balance amount will be cleared, is also not verified. Okay, because in the planned audit work, you are just verifying that whether the receivable balance is included or not. Further, planned audit work also fails to verify that whether this transaction is done in reality or not. Okay, whether asset is removed from non-current asset register Okay, whether gain or loss on disposal is recognized properly or not. Okay, so the planned audit work fails to verify that whether the transaction has been done in reality or not. So what we had to do in this part was we have to evaluate that the component auditor's work was sufficient or not. Okay, he gave us two issues here. One was of payroll, where we discussed about the ethical issue that we were providing the payroll and we were also doing audit. And then there was sale of property to the group CEO. Now in payroll, the only audit work done was to match the balance, just that. With the report, we ourselves prepared. And in sale of property, we just matched the receivable balance. That was the only audit work which was done. So we argued that in relation to the payroll, there is a self-review threat. It's not permitted in the listed entity. And the audit work performed is insufficient. Then as far as group CEO transaction is concerned, it is considered as immaterial, which is wrong. If you look at the component auditor strategy, he says that it is not material. Why is it not material? It's a related party transaction. It is material due to its nature. It's qualitatively material. Then we discussed that as per IFRS, a disclosure note will be required. So the component auditor should think about the group audit work also. Group auditor will require him to do. Then market value of the asset, the balance date, nothing was verified. Okay, audit work also fails to consider that whether the transaction is done in reality or not, whether the asset is moved out physically, whether it has been removed from the non-current asset register or not. So 1 mark for each point. We evaluated the strategy 1, 2, 3, 4, 5, 6, and 7. 1 mark for each of the evaluation, that what were the errors in the planned audit work. So if you find a requirement like that, I believe that it's not difficult. What you need to understand is that you just have to comment on the planned audit work, that whether that work is right or wrong. So this was a routine requirement. I believe that it was not a difficult one. Okay, so what you need to understand is that having professional marks in the exam is nothing new. Just what you need to make sure is that you are concise, you use professional language, okay? You communicate properly, you evaluate the scenario completely, okay? Now, if I go back to the partner's email, then we have 6 marks for some principal audit procedures. Design the principal audit procedures to instruct the component auditor to perform on the sale of property to group CEO, 6 marks for principal audit procedures. Now, I believe audit procedures is an easy requirement. So part B, 2, principal audit procedures on sale of property to group CEO. Okay, now we have to design the principal audit procedures, which is obviously an easy requirement because writing the procedures is never a difficult thing. But only thing which you need to make sure here is that your procedures are complete and comprehensive. Okay, so let's look at them. Now, if we read the transaction again so that we can determine the procedures, Darrell Company sold a small unused building located on the coast to the group CEO in February 2005 for $50,000. The amount is still outstanding for payment. The group CEO is planning to use the property as a holiday home. Now, the planned audit procedure is just to confirm the balance in receivable with current assets. Now, what should be the principal audit procedures here? Now, first of all, you need to understand that it's a related party transaction. So we need to make a certain disclosure of it, in which we have to give the fair value of the asset, Okay, we need to check the gain and loss on the disposal. We have to give the due date. Since it's a related party transaction, so it must be approved by the CEO. So let's develop some principal audit procedures which we will be performing. Okay, review board minutes to verify that whether sale of building, sale of property to group CEO was authorized by board of directors or not. Okay, related party transactions need to be specifically verified, or I would say approved, by the board of directors. So what the examiner says that the students write very brief procedures. They don't explain the procedures. So make sure you write a complete procedure. Review board minutes that whether sale of property to group CEO was authorized by board of directors or not. Then verify market value of the property by reviewing market data of similar properties. Okay, because the transaction is related party, so we need to verify the market value. Disclosure needs to be given in financial statement about market value of asset and whether transaction was done on arm's length basis or not. So we need to verify that whether the transaction was done at market value or not, and for that we need to verify the market value of the asset. We will review the market data of similar properties. Okay, so the principal audit procedures would include to look at the board minutes. We need to look at the market data. What else we need to do? Just give it a thought. Think about it. Okay, you need to look at the carrying value of the asset from the NCA register. You need to look at whether the management has calculated the gain or loss correctly or not. Okay, review non-current asset register to verify carrying value of property at time of sale to group CEO. Okay, why we need to verify the carrying value? Just give it a thought, because it will be used for calculation of the gain and loss, and this carrying value will be used while recording the transaction. Carrying value of asset would have been used while recording disposal of asset. What else we can do? Obtain management workings of gain and loss calculation on sale of property to group CEO. Values used in gain and loss calculation need to be verified, and gain and loss need to be recalculated again. Okay, so just think about the principal audit procedures. Now, many students ask me that, sir, we are not able to think the procedures, what we should be doing. Just think about the transaction, think about the treatment, and the points will start coming into your mind. Okay, we are disposing the asset, so we need to look at the carrying value. So let's go and verify the carrying value. We need to look at the gain and loss. We need to look at the market value because it will be included in the disclosure. We need to look at the approval. Think further, think more. You need to verify that the disposal has been recorded properly. So you can review the non-current asset register, that whether the asset has now been removed from the register. Then in the disclosure, you need to give information about the due date. So you need to have a confirmation that by what date the balance will get cleared. So think about the transaction, think about the treatment, and the procedures will start coming into your mind. Okay, review non-current asset register to verify that asset has been removed from register and it has been recorded as disposed in appropriate manner. Okay, make sure that it's removed in the NC register. Make sure that its depreciation is not charged in the current period. Think about the transaction. Okay, it's a related party transaction. We need to record the transaction. We need to give the disclosure. Now, what you have to give in the disclosure, you have to write that whether the transaction is arm's length or not. What's the amount due? So it's written in the question that $50,000 is due. Now, what's the due date? Obtain representation from group CEO to verify the amount due of $50,000 and expected payment date of this balance. This information needs to be given in related party disclosure. Then think further. You need to look at the subsequent events if the balance is cleared in the subsequent period. So basically what I'm trying to say is, when you are writing the procedures, many students ask me that, sir, while we develop the procedures, we get stuck. So whenever you are writing the procedures, just think that what the transaction is about, how it will be shown in the FS. Just open the treatment in your mind and the procedures will start coming. Since it's a related party transaction, so it must be approved by the board. You need to give market value in the disclosure, so go and verify it. You need to look at the carrying value for recording of the transaction, so go and verify it. Look at the gain and loss. Look at the NC register, whether it's removed from the NC register or not. Whether what's the balance due, what's the due date. Okay, so how many marks for it? 6 marks. So 1 mark for each procedure. So 1, 2, 3, 4, 5, and 6. If I would have to written more, I would have written that we'll review the subsequent events to verify that the asset is removed. We'll look at the subsequent events to verify if any amount is paid in the subsequent period. Okay, so you will look in the subsequent period, because whenever any such balance is due, we always look at the subsequent transactions. Okay, just a second. Okay, so in this requirement, we had to discuss the principal audit procedures. I hope you people are getting it. Principal audit procedures in relation of sale of property to the group CEO. So here was the transaction of group CEO. It was written here that a small unused building was sold to group CEO for $50,000 and the amount is still outstanding for the payment. The only procedure which was performed was to verify that whether this amount is included in receivable. Now the examiner asked us to write 6 procedures in relation to it. So how will we draft these 6 procedures? Just clicked our mind and we start thinking that, okay, I have to give the market value. So go and verify the market value. Okay. I have to look at the gain and loss calculation. I have to look at the carrying value. Okay. I have to look at the due date. You can write one more procedure, as I told you can write that we look at the subsequent period transaction, if any balance is paid in the subsequent period. You can look at the financial statement and the draft FS and verify that whether the disclosure is complete or not. Okay, so I hope that you people are getting it. Only thing the examiner is expecting is that while you draft the procedures, be complete. Don't write very small procedures. Okay. Now let's move towards the last requirement, which is use Exhibit 5, discuss whether it is appropriate for joint audit to be performed on Micon company. Comment on advantages and disadvantages of joint audit, 6 marks. So now we are moving towards part C, evaluation of joint audit proposal for Mikon company. Okay. Now, when we talk about joint audit, just giving you a reminder, what is joint audit? That two audit firms will work together. What is joint audit? That two audit firms will work together. Okay. They will share the responsibility. They will share the work. So let's read the Exhibit 5, where he has given some detail about the joint audit, and let's draft the answer then. I want you all to concentrate on it, okay? Now, the Group Audit Committee has suggested that if the acquisition goes ahead due to the distant location of the company and the fact that Atlanta company has no offices in Farland, a joint audit could be performed with Mikon company's current auditor, Lucille Associates, a small local firm of chartered certified accountants. So the group auditor is saying that as far as the component audit is concerned, what we'll be doing is that we'll go for joint audit. Now the examiner is asking that discuss whether it is appropriate for joint audit to be performed, commenting on advantages and disadvantages. So we are provided with 6 marks. So let's think about the advantages first, and then we'll comment on disadvantages first. We will go for joint audit. The benefit will be that Lucille company is the current auditor of Mikon company. So they will have the knowledge about the client, and their knowledge of the client will help us in understanding the audit of Mikon company, since they are the current auditors. So then you can say that Atlanta company has no offices in Farland. So using Mikon company will be beneficial in the joint audit, because since we don't have offices, so their resources will be helpful to us. Then you can say that it's a completely different country, Farland. Okay, it's a foreign subsidiary which is located in Farland. You can read it here. So maybe other country has different regulations. So going for joint audit will help us in understanding the regulations also. So just look at it while I develop the answer. If Atlanta company will go for joint audit at Mikon company with Lucille company, then it will be favorable as Lucille company is an existing auditor, of Mikon company. They will have understanding of Mikon company's business and environment. This will be useful for Atlanta company, which is our firm. This will be useful for Atlanta company while auditing Mikon company in joint audit. Okay, if you go for a separate audit, we have to gain the understanding of the business and the environment. But if you will go for joint audit, our co-firm will have those expertise. Now, I hope you all remember that in joint audit, there is joint liability and two firms share the resources. So if Atlanta company will go for joint audit at Mikon company with Lucille company, then it will be favorable as Lucille company is an existing auditor of Mikon. They will have understanding of Mikon company's business and environment. This will be useful for Atlanta company while auditing Mikon company in joint audit. Further, Mikon company is located in a different country of Farland. Okay, Farland may have different laws and regulations, and Atlanta company may lack expertise in relation to them. If Atlanta company will go for joint audit at Mikon company with with Lucille company, then it can gain benefit of Lucille company's knowledge about Farland's laws and regulations. Okay, and since it's a different country, maybe you don't have the knowledge of local regulations, so you will get knowledge of local regulations also. Then, Atlanta company do not have any office in Farland. Okay, going for joint audit will help Atlanta company to perform audit of Macon company without sending too many of its resources to Farland. Okay, since we don't have a local office there, so if we go for audit on our own, we have to send the entire team. But if we go for a joint audit, then we can use the resources of Lucille company also. Atlanta company do not have any office in Farland. Going for joint audit will help Atlanta company to perform audit of Macon company without sending too many of its resources to Farland. Ground level work will be done by Lucille company, and Atlanta company may get itself involved in later stages of audit. Okay, so we can do that the ground level work, the field work is done through Lucille company. So we are evaluating the joint audit proposal. But you all know that nothing comes with advantages only. There will be problems also. When there is joint audit, there is joint liability. So if Lucille company will not work with quality, then it will create joint liability of Atlanta company also. There can be issues in relation to distribution of work also. Joint audit can be expensive also. Okay. However, joint audit has certain problems also. First problem is that joint audit becomes expensive for a client as it has to pay 2 audit firms. Macon company may not be willing to use 2 firms for its audit. Obviously, the joint audit is a proposal of Atlanta company. You can read it here. Joint audit is a proposal of Atlanta company. The group's audit committee. Sorry, it's the proposal of the entire group. Okay, so yes, it's not the proposal of Atlanta company, it's the proposal of the group, but still, it may become expensive for that component specifically. Okay, so however, joint audit has certain problems. First problem that it may become expensive. Okay, but since it is a proposal given by the group audit committee, so they must be prepared to pay for that. But it is a problem normal. Then, secondly, what you can say is, in joint audit, liability of audit firms is joint in case of any claim. Atlanta company, which is our firm, needs to consider that if audit work is not done by Lucille company according to quality standards, then Atlanta company will be jointly liable for the issues created in entire audit, Now, this cannot be like this, that, okay, 3 areas are mine, 3 areas are yours. No, the entire audit liability is shared. Even if that area audit is done by Lucille, then also we will also be answerable for it. So first of all, we wrote some favor points that existing auditors, so they have the knowledge of the business and environment, then the laws and regulation, then we can use their resources. But from the client perspective, it gets expensive. But since it's a proposal of group audit committee, so they must have thought about it, but still it is an expensive option. Then the issue of liability. Lastly, you have to think about the division of work, how we will divide the work. Maybe there are disputes in distribution of the work. This is also a big issue. There can be disputes on audit methodology. Okay. Lastly, now since there are 6 marks, so we are writing one point for each mark. Lastly, in joint audit, issues can arise on distribution of audit work. Atlanta company may not be able to agree on distribution of audit work and audit methodology with Lucille company. Normally, this is the reason why the firms don't go for joint audit, because when they go for joint audit, who will decide that who will do which work? And even other firm is doing any certain work, then also the liability is shared. Okay, so lastly, in joint audit, issues can arise on distribution of audit work. Atlanta company may not be able to agree on distribution of audit work and audit methodology with Lucille company. Okay, so distribution of work is one of the issues which will be faced. Now, if I ask you to give a recommendation, because it's the requirement, it was clearly written, discuss whether it is appropriate for joint audit to be performed, commenting on advantage and disadvantage. Now, if we go for a recommendation, that what should be done? Considering advantages and disadvantages, it is advisable. Now, my advice would be that despite that there are disadvantages, we should go for joint audit. The primary reason being that we don't have the offices there. Okay, the office issue is very important. Considering advantages and disadvantages, it is advisable that Atlanta company should go for joint audit. Okay, why it should go for joint audit? Should go for joint audit because it do not have local office in Farland. Due to this reason, they may not have resources and expertise in Farland to perform audit of Micone company individually. Okay, so it is better that we go for joint audit. Despite that there are problems, but still it's advisable. So we have to evaluate the possibility of joint audit. That if you go for joint audit, you said that Lucille company is their existing auditor. So the existing auditor will have the expertise. Okay, here it was written, joint audit could be formed with the current auditor. So the expertise will be shared. Then we said that since it's a different country, so there will be a problem of regulations. Then we said that we don't have resources there. So going for joint audit is a better option. But then there were problems like expensive audit, joint liability, distribution of work, and then we gave an advice. You can add more points also in it. Like you can say that if there is a joint audit and 2 audit firms have good synchronization, they sync in a better manner, and it's a joint audit and 2 firms perform joint audit pretty much well, then it will be favorable that they will be able to convince the client in a better manner. Like if there is a dispute on any accounting treatment with the client and 2 joint auditors agree on the same treatment, then they can convince the client in a better manner. Like for example, if there is a single auditor, the client says that I'll go for a second partner opinion. But in joint audit, if there are 2 firms working together and they both agree on the same treatment, they can convince the client in a better manner. They will not get intimidated from the client. Okay, so you can add few more points also. So we have to evaluate the proposal of the joint, that whether going for joint audit would be better or not. So I think that this was a simple rote learning concept. It was not difficult. So the part A was audit risk, which we have done. Then part B1 was component auditor strategy. Then there were principal audit procedures. And lastly, we evaluated the joint audit proposal. I hope that you are getting it. So if you look at the entire answer, first we started with the format of the briefing note. Then we moved towards the introduction. Then audit risks were written and we sorted them out also. I hope you all remember. Then we moved towards the evaluation of the audit strategy of Negan Associates. Then we wrote principal audit procedures. And lastly, the joint audit proposal was written. Now, due to professional marks, it is better that you add conclusion also. Due to professional marks, it is better that you add conclusion also. Okay, I would say that it's not mandatory, but if you add, then it is better. Okay, so we wrote audit risk. So in the conclusion, you can highlight the significant audit risk. Okay, it can be concluded that significant audit risk in RIG group included wrong approach of revenue recognition, legal claim filed by Glen Company, and wrong approach, or you can write the first three ones, like the first three one was revenue recognition, then legal case, and then amortization of license. And wrong approach of finance director in relation to amortization of licenses. Further, in relation to audit strategy of Negan Associates, there were flaws in planned audit of payroll and sale of property to group CEO. Further, ethical issues also existed in relation to Negan Associates audit. Okay, so basically we are concluding each of the requirement. We are picking key points. The first one was audit risk, so I refer the most significant one risk. Then I move towards the audit strategy. Then the planned audit procedures, principal audit procedures, I would say. Principal audit procedures on sale of property to group CEO were related to, or I would say, included verification of elements which are required to be disclosed in related party note. Lastly, joint audit proposal of audit committee, of group audit committee in relation to, I would say, Micone Company seems to be acceptable considering lack of Atlanta Company presence in Farland. Okay. So basically, while we write the conclusion, what we do is we simply pick up the key points which we have covered. Like if you read my conclusion, it can be concluded that significant audit risk in RIG group included wrong approach for revenue recognition, legal claim, and wrong approach of finance director in relation to amortization of license. So this sentence concluded the audit risk. Then the second requirement, evaluate the extract from component auditor strategy commenting on the audit commenting on the audit strategy, responses, and ethical matters relating to the issues. So further, in relation to audit strategy of Negan Associate, there were flaws in planned audit of payroll and sale of property. Further ethical issues also exist. Then for principal audit procedures, we said that majorly the procedures were related to related party disclosure. And lastly, there was joint audit proposal. So if you look at this entire answer, this was the question number 1, which was of 50 marks. I know that some of the students may feel that today's session was a bit dragged and it was very lengthy, but believe me, this is the only approach to learn the drafting. Okay, my objective is that while I draft the answer, I don't skip anything. We pick up each and every small thing. And we draft like an exam situation. We read the entire scenario. We draft each of the points. And since now the professional marks are very much important, you people need to understand that how you develop your answer. I hope that in the today's session, you have understood the drafting, the approach, that how I deal with the question. In the next class, we move towards question 2, and then we move towards question 3. Then we have second specimen exam and so on. Only solution in AAA exam to get good marks is practice. Practice with a tutor and practice on your own. See, I always say that it is very simple for me to teach like other tutors and just give a summary that, okay, you will do this. And students also like this. But what I believe is that just taking a bird's eye view will never make you competent enough to draft the answers. You need to look at each of the answer in detail with the tutor. You need to understand that how I draft the point. You need to take the learning. And once done with this, what I want from you people is that you have to draft complete answers and send me for the mark. So if you look at it, we started with the briefing note, we wrote introduction, I drafted each and every audit risk with you. We evaluated the audit strategy, we looked at principal audit procedures, we evaluated joint audit, and then we also wrote the conclusion, since now there are 10 professional marks. So you need to understand that your structure, your communication, your coverage of the question, your evaluation, okay, you have to make sure that each and everything is covered. Okay, so like if you talk about commercial acumen, so while you are talking about joint audit, so we are using commercial acumen. That since we don't have an office there, so going for an audit on our own will create issues. I hope that my today's session have added value towards your chances to pass the exam. In the next class, we'll move towards question number 2. If you people have any query, feel free to ask. Okay, thank you everyone.